Financial service group Nedbank saw its shares price tumble over 5% on Tuesday after lowering its full-year earnings and return on equity guidance. This comes despite interim results slightly ahead of market expectations. Moreover, the bank now forecasts low single-digit growth in diluted headline earnings and ROE of around 15% for 2025. Analysts say underlying growth is closer to 1% once one-off gains from Eco Bank and Extra are excluded. Meanwhile, operating expenses rose 9%, with the cost-to-income ratio up to 57.4%. Investment analyst Tumble also shared further insights into the bank's performance.
So Nedbank released half-year results that show the performance in diluted headline earnings per share, or what we typically call the bottom line, grew 7% year-on-year, which was better than management's previous guidance for broadly flat growth, but also tracking ahead of market consensus expectations for the full-year print. We saw this was driven by growth in non-interest income activities, so strong commission and fee income, equity investments and trading income, as well as a positive contribution from associate income growth, specifically the investments in EcoBank, which delivered higher than expected earnings year-on-year. Nedbank also benefited from an ongoing improvement in impairment charges. Here, these are the losses that banks will typically incur from customers who aren't able to pay off their debts. They saw an improvement there, which was positive, but also good management of underlying expenses growth was also supportive. The muted NII, or net interest income growth, created a partial offset, but that's been more of a sector-wide experience given the interest rate cycle. When interest rates are elevated, loan demand typically slows down and vice versa. But in any case, across the divisions, we saw the Africa regions being the biggest driver of earnings growth, which helped offset more marginal growth in corporate and investment banking, as well as the retail and business banking segments. The wealth business was also quite flat year on year. But overall, the group's balance sheet metrics remain quite strong. So cash, or the capital position, enabled the declaration of an interim dividend, which was up 6% year on year. So decent results overall, but management's outlook statement was quite soft. They downwardly revised earnings per share guidance due to a tough local trading environment, but also a change in business strategy around EcoBank, specifically leadership's plans to sell the stake in that business, all of which led to a meaningful sell-off in the share price.